Let me start by thanking Doug and Amit for inviting us out here. The title of the paper is Limits of Model-Based Regulation, and it's co-authored with Marcus Ben, who was at the Bundesbank earlier and now just recently moved to the European Central Bank, and with Rainer Hasselmann, who's sitting here with you. So sort of for those of you who were here yesterday for the last paper, sort of this is on the same theme of manipulation of risk weights that we saw for the syndicate loan markets in the US. So when we sort of started with this project, and released the results initially, we got a lot of flack for it, and there were a lot of attempts earlier made to at some point we were not sure whether this paper would actually see the light of the day and we would be allowed to present it. So last NBR, I remember when we presented at the Summer Institute, not this one but the last one, the vice president of Bundesbank was there, and that's when things started going for us because they saw the execution, and that's what we got the permission to go forward. And yesterday when I saw the paper on the US, it was almost music to my ears because we almost feel vindicated that in other settings you can see similar sort of effects as well. So let me get into the way we thought about this initially when we were talking about this question of model-based regulation was related around the theme of complexity of regulation. So the last couple of decades, we've all seen increase in the inherent complexity of the financial system. The financial systems today are much more complex. And what has happened is in lockstep, financial regulation has also grown in complexity. And when you ask people, what drives complexity of regulation, you sort of get different views on it. One being that, a complex financial system requires a complex set of rules and regulations to make sure things function properly. There are some others who are concerned about, the arguments that are out there, which is that there may be some reverse causality out here, which is it's just the complex regulation that drives the complexity in the financial system because of regulatory arbitrage reasons. There's now a sort of a growing recognition that there may be some sort of a regulatory capture view that might be driving complexity of regulation, because complexity is some sort of thing that is lobbied by certain players because it sort of builds barriers to entry, and this is, this allows them to sort of generate rents. I'll sort of come back to this point a bit later in the discussion. And just to sort of give you stuff from, you've all seen this, and I'm sure a lot of you have different views about it, but this is just from Andy Haldane's article about, he discusses the growing complexity of financial regulation. This is about Basel I, how simple it was, then Basel II and Basel III, how things are growing in complexity, as measured here simply by the number of pages, and things like that. But it's sort of a trend that you see in other regulations as well, where things are sort of looking more and more complicated. So what we're going to do is we're going to look at one specific regulation, which is bank regulation, which is related to capital charges. And we're going to see this introduction of the sophisticated regulation, the model-based regulation, which will become a bit clear as I sort of go along in the presentation. And so the model-based regulation was a key innovation in Basel II. Prior to, like in the Basel framework, what you had is you had very simple 5 buckets that were constructed, and if your asset belonged to any of these 5 buckets, your risk weight was determined based on which bucket it was. And people sort of felt that this sort of way of taxing, let me put it this way, was very coarse, because you would tax all the assets in the same bucket with the same flat capital charge. And people said, we need a bit more sophisticated regulation, and that's what gave rise to model-based regulation, which was the idea that we should sort of tax higher riskier assets with higher risk at a higher capital charge and low risk at low capital charge. And so they felt that this coarse regulation, which is Basel I, was sort of, creating a lot of distortions, and having a very fine-tuned model-based regulation would generate a better allocation of resources. Okay, and of course there was these things about enhancing the financial stability. So what we're going to look at sort of 2 questions. One is, what is the effect of Basel II on credit risk? And then in the second one, we'll say something about how, some real side effects of this. As I already mentioned, and it was also clear a bit, Joao did a fantastic job in explaining the 2 regulations. So this is a standard approach which people refer to, which is the pre-reform, pre-Basel II reform. Coarse buckets, and you have a flat capital charge. I mean, just to back out, so there's, the reason why these regulations, one of the reasons these regulations are in place is that there is some view out there that there's some mispricing of debt, some sort of a deposit insurance or whatever it is, and this makes people choose some sort of suboptimal debt levels, and given that bank failure is costly to society, you sort of think of capital charges as a way of correcting for this. So you can think of that as some sort of a Pigouvian tax that is applied to it. So that's why I'm sort of using this word of flat tax. And the post-reform framework, which is this model-based regulation, you had these complex array of risk models calibrated by the bank, approved by the supervisor. And if you look at typically a large bank, it had 100 such models, over 100 such models, with lots of data to estimate, several thousand parameters, and then updated, and these were used to set capital charges. Okay, so again, two views. The benign view of this was sort of Basel II resonates with the economic principle of he who pollutes must pay, as opposed to everybody being taxed at the same rate. And in a world with no with no enforcement and information restrictions, you can think that such a precise regulation should enhance welfare. But there is this alternate view out there, which is one being that these models perhaps can be manipulated. Okay, and there is a literature, Glaser and Schleifer, and you could put other names out there, which tries to make a case that in a world where enforcement is difficult, some sort of coarse regulation, or in economics you have these quantity regulations, may be the way to go about things. Okay, and of course there's another view, which is the regulatory capture view that I mentioned earlier, that maybe it's complexity is being generated because of, or sophisticated regulations being generated because this allows certain incumbents to actually generate higher rents because it builds barriers to entry. So every country has had different experience in terms of how this regulation was implemented. The setting here is going to be Germany, and I'm going to give you a detail about how it was implemented in Germany, and then I'll show you what we sort of find in the data. So there are two approaches to determining the capital charge. One is this model-based approach, which is referred to as IRB. I'll call it the IRB, and the other is just the standard approach. So the way it sort of worked in Germany was there are about 1,600 banks that are operating in Germany. When this regulation was introduced, the regulators gave this option to the banks whether they wanted to go for the model-based regulation or continue with the old regulation, which was a standard approach. So they said, you know what, you have to raise your hands whether you want to go for the IRB approach, and if you didn't want to do that, you would stay on the standard approach, which was Basel I, effectively. Now, of the 1,500 banks, and I'll show you some data on that a bit later, that were given, I think 1,600 banks that were given the option of going for this new model-based regulation, only the 45 largest banks actually went for it. And one of the reasons the others opted out was the compliance costs of sort of, getting all these risk models in place was very high, and only these big banks could actually afford to have these in place. Okay? Now, of the 45 largest banks that went for the IRB, banks have different portfolios, and you had different models for different portfolios. The regulator had to approve the model before it you could apply that and you could set your capital charges based on that. Right? So what happened was that of these 45 banks that wanted to go for it, they submitted their models to the regulator, and then the regulator decided, I'm comfortable with these models, but I need more time and more data to make sure these models are stable. And so what you have is, of these 45 banks that went for the IRB approach, there were some banks or some portfolios that went first, and the others sort of went a bit later. Okay? That's sort of, now the portfolios were defined by the regulator. So the regulator would say, this is an SME portfolio, which means, let's say firm's corporate loan portfolio. So if a firm is there, the portfolio is decided by the regulator. But for some IRB large 45 banks, some of these portfolios will be shifted to the model-based approach because the regulator felt very comfortable with the model. But for the others, it actually stayed on the old approach till the time the regulator felt, now I'm ready for it, and I'm ready to sort of move this portfolio onto the model-based approach. Okay, so there is this sort of a staggered introduction of this regulation. I'm going to show you 5 graphs which basically tell the whole story. So we're looking at this. These graphs are basically looking at the 45 largest banks in Germany that raised their hands when the regulators gave them the option of choosing whether they want to go in the IRB approach or the SA approach. And what this basically, so in the blue what you see are these SA loans of these IRB banks. These are the large 45 banks. So these are the portfolios that have not shifted yet. All right? And these are the IRB loans where the regulator said, yes, I'm happy with this. Now you can use this for, you can shift this to the model-based approach. But what you're seeing out here is the following. You're seeing that the loans that have shifted to the IRB where the regulators have felt comfortable, so what is being plotted out here is PD, which basically measures the probability of a default, which captures what's the probability of a default of a given firm in a year from now. That's what it's measuring. So what you see out here is, you see the red ones. For example, if I were to look in 2008, these are all the loans that are outstanding in 2008. You see the average is about 0.015, which basically means that 1.5% of these loans are expected to default in a year from now, which could be that these are safer loans. Regulator felt comfortable in these models and they allowed these loans to go through. The blue line are these SA loans, which are still on the old standard approach. And the PDs, because the regulators knew, they were submitting the models to the regulator, so you have this PD in the data. And what you see, this is about 2.6%. So what you can see consistently year by year when you look at it, what you see is that it looks like that these loans, the SA loans, are riskier than the IRB loans. All right? Now, you can actually look at what happened to the loans, going forward, because you have data on it, and you can see how did these loans do. So this is the next slide looks at the actual default of these loans. And what you find is that if you note out here, the blue line was higher than the red line. When you measure the actual default rates on the loan, it sort of flips signs, which is that these loans are sort of defaulting more. Now, nothing can be said about this. This could be some macro factor that was these groups are different. Macro factors could have different sensitivities to these two groups. If a model, if there's high default, we cannot say anything about it, and I'll speak to all that in a bit. But what you see in this just simple pooled data, comparing apples, oranges, that there is this reversal out here. The red is lower than the blue, and then what you see is that the actual default of the IRB loans is higher. Right? Now, there is something called risk weights, which is tied to the probability of default. And what you see is that if you plot the risk-weighted assets to loan, you have a similar thing just because it's a mechanical relationship. The regulator, there's something else which is the correlation of default, which the regulator gives you. You plug that in and you get the risk-weighted assets. But because the PDs are like that, you get risk-weighted assets in the same way. And just because the defaults are high, you can also calculate what the loss rates are. And you find the same patterns there for the loss rates as well. So this thing. Now, what we have is we were able to get from a different source. You could look at the interest rate that the banks were charging on these loans. So it could be that when banks were originating these loans, they felt these were safe loans, and that's why they were giving lower PDs to it. Macro conditions moved in a certain way that were unanticipated. So what you also can see is, here's looking at the interest rate charged on this group of loans. Okay? And what you see is, while the PDs do a poor job in predicting default, the interest rates line up very nicely in terms of how these loans performed going forward. Okay? So sort of suggesting that the risk was somehow banks were aware of this risk. And what I'm going to do in the next part of the presentation is I'm going to go to micro level data, and I'm going to show you these 5 graphs that I've shown you out there actually we can identify that and sort of control for apples versus oranges or other stories that are coming to your mind. Okay? But this is basically the 5 graphs to keep in mind, and everything that we're going to do is going to be just verifying this story that you see in this graph. Okay? So I've talked about Basel II, 2 broad methodologies, standard approach, the IRB approach. There's something that I want to mention, which is the advanced IRB approach, because I'm going to come to that. So of these 45 banks, right, which went for this IRB approach, and the regulators allowed them to go, there was something which was called the advanced IRB. Some banks in this subset of 45 were also given the choice to model their loss given default. Okay, so there was, the regulator had given, earlier for most banks it was just the PDs, and then everything was linked through a formula. But it says, you know what, we actually feel comfortable with the other models, and we can also allow you more flexibility with doing that. And I'll come back to how this extra discretion played out in the data. Now, we saw this graph a bit yesterday. What you see basically is, this is basically the graph that you see in, the mapping that is there from the PDs to the risk weights. There is some, correlation built into this. But basically what happens is that you come up with the PD of the probability of default, and then you say, let's say the probability of default is 0.01. You go up out here, you see the risk weight is 100% or 1. That basically means a capital charge of 8%. If on the other hand it happens to be higher, your capital charge happens to be higher. Now what you can see is that already is that, as we sort of mentioned earlier, there's a curvature attached to this stuff, right? And what we know from economics is that when we sort of given a nonlinear schedule, that can open up possibilities of gaming at times. So a delta manipulation out here, all right, offset by a delta manipulation on the other side, will make the whole portfolio look exactly the same because the prediction errors would sort of come out, but you actually saved on the risk weights just by doing that. Okay? I'll come back to this idea when we sort of look at the data a bit later. All right, so the data for this study comes from the German credit register of the Deutsche Bundesbank. And what we have is basically we're looking at firms out here, and we basically have data at very granular level, PDs given by the different lender from 2008 quarter one till about 2012 when we sort of looked at it. We also have data on balance sheet and income statement data from the Bundesbank. There's a separate data set, Ustan data set, which actually gives you detailed information on the firms. The sample period is from 2004 to 2012. Okay, and I'll show you something like that. So just to give you a sense of, just some brief numbers out here. In the beginning, I mentioned that there are about 1,600 banks that are operating in Germany. All right. So what you see out here is these are the banks that did not opt for this IRB approach. And these are these 45 banks that I was mentioning earlier that raised their hands and said, we want to go in for this IRB approach. And what you can see is that if you look at the size of these banks out here, you can see these are the largest banks. Okay? Okay, so these are sort of the very large banks in Germany that are doing it. I'll show you some results which are not in the paper about which type of banks these were. And then we'll talk about it. All right, so what you see out here is that, size I've already mentioned. Now you can also look at some summary statistics, which you've already probably seen in the graph. This is the SA loans. It's sort of similar to the graph that the PDs are lower, but the actual loss rates and defaults are higher, and the interest rates are sort of moving in the same direction. But let me come to the main identification strategy that probably would address what Gary's concerns on apples and oranges were. It's sort of, so what we have is in our sample, we have firms. So let's look at these 45 largest banks. I'll call them the IRB banks. Now imagine the banks just have two portfolios, and the IRB portfolio corresponds to the portfolio which the regulator has approved to be on the model, where you can use the models. The SA portfolio, on the other hand, happens to be the one where the regulator at the moment is not comfortable, but maybe 2 years down the line he says, yeah, now I'm comfortable because there's enough data and I can actually, I can move it to the model-based approach. So what we're looking at, we're looking at a set of firms that are borrowing from these two banks. Both IRB banks, but in one case the portfolio has moved. The SME portfolio has been approved. The regulator has given a thumbs up. Great, I like your model, go for it. The other, the regulator is a bit not comfortable at the moment and says, I'm going to watch a bit more to see that you have more stable parameters, and it stays on the SA approach. Okay? So we're going to look at the same firm, look at the PDs that are being offered by the IRB bank if it belongs to the IRB portfolio, by another IRB bank if it belongs to the SA portfolio. And what you see is systematically, if you look at the same firm, the PDs that are given by the IRB portfolio of the IRB bank are systematically lower than the PDs given by the SA portfolio of the IRB bank. So this is basically the setup that I'm going to look at, I'm going to take to the data, and I'm going to try and identify it. So all the things that you saw, if you remember those 5 graphs, it's what I'm going to try and see, holding the firm constant and try and show that the same pattern exists there. So effectively, I'm going to look at things like the reported PDs of a given firm. So again, I'm looking at a subset of firms that are borrowing from these IRB portfolio and the SA portfolio of an IRB bank, and I'm looking at the PDs that are being reported by them. And so this is basically a regression which looks at some variable of interest, let's just say the probability of default. And what you have is, so here I, J, T, I firm, J bank, time T. And what you have is you have a saturated specification where you're looking at the same firm in the same year borrowing from these two banks. And you also have, to control for some sort of bank-specific shocks in a given year, you also have saturated specification by adding these bank times year fixed. So if there's some sort of something specific to a bank, all those things would get saturated away, and we can sort of control for that. And then what I have is the variable of interest, which is basically trying to capture whether this portfolio belongs to the IRB side or it belongs to the SA side. Okay, these can have different models, and we're going to try and see that. So what you see is, what you see out here, this is basically just the log of PD out here, which is looking at, and these are the fixed effects that I mentioned out here. So looking at the same firm in the same year, firm borrowing from two banks, one on the IRB portfolio and one on the SA portfolio, you see in all specification, no matter how you saturate it, you get a very strong result, which is that the reported PDs from the IRB side are lower than the PDs from the portfolio that is on the SA side. Okay? You can actually calculate the estimation error, which is basically just trying to capture what the actual default minus the PD is. And what you see is that the SA loans have no such prediction error. But if you look at the IRB loans, again, adding all the specifications that you can, you see a positive prediction error. Prediction error is basically the difference between actual default minus the reported PD. And you see that the IRB banks are actually having a strong prediction error. Now, you can do the same thing with risk-weighted assets. It's not surprising. It's a mechanical relationship. So if I show something in PD, it automatically will apply to risk-weighted assets. And you see the same things, that these reported PDs correspond to a lower risk-weighted assets. And then you can look at the loss rates again, which is similar to the graph I showed you, that these banks, IRB banks, have a higher loss rate. Okay? You can look at the interest rates that these banks are charging, just like the graph that earlier. And again, you get the same pattern, which is what we had earlier, which is while the PDs do a poor job in predicting default for these guys, the interest rate to some extent does a much better job. Okay? Now, there may be concerns that are going through your head, or maybe not. It's just too early in the morning. But there could be stuff that was pointed out earlier, that maybe there's something different about SA or IRB loans. Maybe SA loans are not updating as much, or whatever it is. So what we look at is we do some sort of analysis which is within these IRB banks. So here's sort of a table which looks at the cohorts. So we look at the data, all loans in 2009. All right? And some of these loans are originated just before in 2006, and some of these loans are originated in 2007 after the Basel II has been passed. All right? So you're looking at the same set of loans. They're 2009. You're looking at all outstanding loans, but you have the origination date of this. Was it originated in 2006, or was it originated in 2007? What you see is most manipulation is coming from these new loans which originated after the Basel model was in place. The prediction error from the previous loans, those PDs tend to do a pretty good job in 2009. So you can see the same patterns in 2009. SA, there is no effect. IRB, there is an effect. And the same thing happens if you look at the 2010 portfolio that is outstanding, and you sort of get the same pattern out there. Okay? Now, I mentioned earlier that we also have this non-linearity in the mapping between PDs and risk weights. Right, which is that if you manipulate a PD, the lower side of the spectrum, the curvature is steep, so you get a bigger bang for the buck. On the other hand, on the higher side, it sort of starts to flatten out. And then that's exactly what you see, is that a lot of times you look at the entire portfolio, they seems to be doing okay, but it happens with the manipulation where you manipulate a bit on the lower side, the opposite on the other side. But you see that the prediction errors are a lot of them are coming from these low PD loans, and I'll show you some stuff on that. There's something on bank capitalization, which is similar to what we saw yesterday, which is the banks that had these binding capital requirements. They're the ones that were manipulating it more. It's a bit tricky to interpret it, but we'll talk about that maybe in the discussion. The last I'll talk about is the advanced IRB and the IRB approach. Right? I mentioned earlier that there are these two approaches in these 45 banks that they were allowed to do. So some banks were only allowed to model the probability of default. The regulator gave them correlation of default that went into the formula, the loss given default, and all these were then mapped, and the risk weights were being calculated. In some cases, the banks, and these were even the bigger of those 45 banks, they sort of convinced the regulator that they have actually better models for even loss given defaults and things like that. Okay? And so they were even given the discretion to model that, and the regulator had approved it. And what you see is that the more was the discretion given to the banks, the more they manipulated these things. It was not the PDs now they were manipulating now the loss given default. So where the manipulation happening had changed, but overall the risk weights were much lower and the defaults were much higher. So they were taking more risks, but they were actually setting much less capital aside for that. Okay, so I'll show you some stuff on that. Okay, so this is basically the small versus large PDs that I was telling you about. And as I sort of already alluded to you, that all the action is coming from these low PDs being manipulated. The low PDs, where the incentives to manipulate was much higher, was where manipulation was taking place. So you can see that for the IRB, this is a low versus high PD, and this is basically the interaction of the two. You can see that the effects are coming from the low PD spectrum. You can look at, instead of PD, you can also look at the estimation error. You can see that's where the failure of models also happened. It's the low PDs that were manipulated more, and there's the ones that had the higher prediction error going forward, which is consistent with the story that I was telling earlier. Okay. Here's sort of the result, which is similar to what we saw yesterday, which is on bank capitalization, which is, again, looking at which were banks that had the more incentives to manipulate it, and you find that the ones for which bank requirements were more binding were the ones that actually manipulated it the more. So, yeah.
You have on the left-hand side the laws of PD.
We've also done it with the...
Because when you manipulate the small guys, in percentage terms, it's possible to get more in levels too. Because in terms of payoffs, you want the levels, not logs, right?
Yeah, so I mean, you can do it many different ways, but you can look at a set of low PD loans, and you can look at a set of high PD loans, and you can see what are the prediction in the portfolio of low PD loans, and what are the prediction errors in the high PD loans, and you find that the prediction are much higher for the low PD loans. So you can do it as a continuous variable, or you could do it in buckets. You sort of get the same effect, which is there's more manipulation happening from the low PD spectrum.
When we measure it in the space of PDs, not percentage of PD.
The prediction error is measured as actual minus predicted. So if our portfolio of low PD says yeah. All right. Okay, I'm just saying it. I don't want to talk too much about it. There's some stuff which we have to confirm, which look at state versus private, but it seems to be the case that there is more manipulation by the large private banks, and I don't want to speak more on that right now. Okay. Here's the study of basic versus advanced IRB that I mentioned earlier. Okay, I mentioned that there are some banks who were only given the permission to report, to follow the foundation IRB, which was just modeling the probability of default, while the others were given more. And what you again see is the same pattern. The more the discretion given to the banks, the more sort of they've manipulated. So the risk-weighted assets reported are lower, and the loss rates are much higher. And again, if you look at the interest rate, you get the same story. The interest rate seems to be a good job in predicting defaults, but the risk-weighted assets do a poor job in sort of setting what the capital charge is. Let me take the next 5 or so minutes to talk about. So what I've shown so far is what happens in terms of reported PDs and the actual PDs, and try to sort of provide some evidence that there was some sort of underreporting of PDs. By some sort of a regulatory manipulation that was taking place, which I think we showed it controlling for firms, holding the same firm constant. So if there are other sort of stories, But the key thing was the interest rate doing a better job at predicting it, but the reported PDs failing to predict the defaults seem to suggest that the banks seem to be somewhat aware of the risks that they were taking and things like that. Okay, so here's sort of an example of what happened to these largest 45 banks. So this is now going back to the entire analysis and trying to look at SA banks and IRB banks. So this is now, when I say SA banks here, this is the entire 1,500 banks as well that we're talking about. And what you see out here, and I'll show you some, Quagmire type of regressions as well on this, but what you see is that these big IRB banks, what they did after the reform was they sort of used these and they sort of freed up capital and they're expanding the lending. Now, some of this was part of the incentives provided to adopt this, but what you see is that there's a big shift. So if you, for example, look at the German sector after this reform, you saw that the big banks actually became bigger. Okay, so if you sort of worry about this too big to fail, here was a regulation that was trying to promote or reduce systemic risk, but it was subsidizing size. So the big banks became bigger, and we sort of measure Herfindahl index or something to capture credit market competition, and you see that the banking sector became more concentrated around this time. Now, this is looking at IRB versus SA banks, and this regression just shows you what I showed you in the graph is actually true, that these banks expanded more, but you could do the same analysis within the IRB banks, right? The same firm borrowing from an IRB portfolio, SA portfolio, and then you have this, and you see that the same effect is there from that Quagmire type of an estimation that you see out there, which is sort of consistent with, again, you can control a lot more because you hold the same firm constant, but you see the same patterns out there. Let me just spend a few minutes. This is the Herfindahl index that I was talking to you about, and it sort of confirms the graph earlier. All right? So now just a few minutes on speculation, and I'm doing excellent on time. So we were talking about, so the first thing talked about this issue of regulatory manipulation. The second part I was saying about, we talked about this issue of complexity of regulation, right? And so, I mean, this is more speculative than anything else. What I showed you was, at least in terms of the winners and losers, when you look at, who benefited from this, you saw that big banks actually took advantage of this regulation and actually became bigger. All right? Now, there's, of course, a bright side, which is probably there's more credit being supplied because now capital charges have been manipulated or less. But when you talk to the regulators, and this goes back perhaps to Amir's question, which I thought was this. If you sort of talk about this, right, and I presented this, the first type of response was, why have you not detected? It was my question that, I can see these prediction errors are quite large. I haven't done any rocket science out here. And what is driving it? And what they often come back to you saying, we need more resources. Okay? And following that, Bundesbank and other things have advertised for more jobs. They need more PhD in mathematics, PhD in statistics. And what they're doing is they're offering massive enumerations. These are civil servant jobs in Germany, which basically means for life you're guaranteed this job, you're going to get massive pension and things like that. And this is what they believe is that getting more resources means they're going to be able to hire more workers, and they're going to detect this change. Okay, so this is, if you go back history, again, this data comes from this very nice article by Andy Haldane. It talks about, the entire Bank of England, provides supervision by just using 30 employees. That's all that was required. Okay, now what we have, and another way of putting this was in the same period, what you had was one supervisor for every 11,000 people in the finance industry working. There was one supervisor. Right now, at the moment, it's one supervisor for 300 people working in the finance industry. And what is being asked right now is, we need more resources. Okay, I don't know what that ratio ought to be. I don't have the answer to it, but I think something we could discuss in the time that we have at some point. But one of the things when you talk to the regulators, very clear comes out is they need more resources to fix this stuff which they have regularized. Regulatory reporting again, has sort of gone up by a big amount. And when you think about all this that is happening, right, 30 to 50,000 data cells, and the regulators don't know anything what to do with it, but this is the amount of things that they're reporting. Okay, there's a recent study where McKinsey puts just these compliance costs of this regulation as 200 jobs for a large bank, just to comply with these regulations. Okay, so I don't really have, when we talk about who benefits and who loses, we see big banks actually benefiting from it, but there's something which is going on which we can term as regulatory empire building. Okay, the size of the regulation is also growing, and they sort of like this idea because the regulator now commands a big force and something again to discuss and things like that. Okay, so let me conclude. I'm surprised that I'm on time, but I had already mentioned this. Regulation provided an implicit subsidy to size. We saw that. Big banks gained at the expense of smaller banks. And compliance cost was very high, which led to this, large banks benefiting more. We talked about the effects of reform on credit risk measurement. Okay, and I think that's about it.
So let me start while he's doing that and say the theory behind this paper is pretty straightforward. And if you've ever been a parent, you know how you would react to the following suggestion. You're worried about your kid's intake of sugar, and you can either sort of count the number of candy bars, or you can ask your child to, as an exercise, to develop a model of his sugar intake, which will be used to follow how much sugar the child is taking in. Now, no parent, of course, would ever even consider doing the second. And the fact that that's so laughable, and I've been saying for many years that it is laughable, tells you how deeply troubled our regulatory process is. That this was not something that was sort of prima facie, even something that you could have believed from a political economy standpoint was possible to work. And we have, I think, a lot of evidence about this already. But this paper creates perhaps the clearest and most convincing evidence that I've seen. So let me go through it quickly. and then talk a little bit about things that the authors could also do to enrich their story further. So first of all, summarizing the findings, and I want to emphasize that the contrast here is between IRB banks and what you might call would-be IRB banks, and that's important. It's not between IRB banks and little mom-and-pop banks that are operating in a different loan niche and completely different sort of activities. So what they find is the PDs that are estimated by the IRB banks are lower. The actual defaults of the IRB banks are higher. And furthermore, if you also allow to go to the really advanced, and you have to love the word advanced, if you really can go to the advanced approach where you get to also estimate your own LGDs, then those also are lower for the IRB banks. So it's a pretty straightforward point that everything they estimate, they underestimate, and everything that happens is worse. So the actual difference in performance relative to estimate is very large because both the estimate is underestimating and the actual performance is overestimating relative to the benchmark of the weighting banks, the SA banks. This translates into a risk-weighted assets understatement of 10 to 15%. That's a very big effect. I mean, we could spend a lot of time talking about identification. I'm going to take a little time talking about identification. But it's always good to kind of talk about the coefficient. This is big, 10 to 15%. Now, is this purposeful or accidental? I'm going to talk a little bit in a minute about ways that you could conceive it could be accidental. But the next piece of evidence tells you it isn't accidental. That piece of evidence is the interest rate. So the interest rates on these riskier IRB loans, riskier in the sense of ex post performance, are almost a percentage point higher. Now, I want you to stop and think about that. In case any of you has ever been involved in a loan market, a percentage point higher on a loan spread is unbelievably large. This effect that we're talking about is robust when you're doing controls with firm fixed effects. It's almost unbelievably large. So a 1% higher interest rate spread shows you that this couldn't possibly be accidental. Banks do know when they're making a percentage point more interest, and they are making it for a reason, which is called risk. Now, they're going to go on, though, because we live in the world of identification Nazism. They're going to go on to say, but of course there could be firm-specific time-varying effects. And then they're going to develop this low PD versus high PD analysis to try to deflate that. Now, I'm going to talk about why I think that that exercise isn't very convincing. But what I want to come back to is, it doesn't matter that it's not convincing, that low PD versus high PD, because the interest rates tell you that the banks know that the loans are riskier in the first place. So I don't see why we need to be worried too much about time-varying firm effects when we have this interest rate evidence that shows that this is known in advance. We'll come back a little bit to the methodological questions about this PD analysis, but I don't think it's very important. I think it's kind of beside the point of the findings of the paper. Okay, now why are these interest rate findings convincing? Well, of course, in theory, interest rate spreads, if putting aside market power, and there isn't much market power in the loans that these large banks are making, I would say on a prima facie basis, knowing the structure of the lending market in Germany. But we know that banks should be compensating for risk with higher interest rate spreads. But we also have a lot of empirical evidence. So in a paper that Don Morgan and I think Styro did in, I think it was the Journal of Financial Services Research about maybe 12 years ago, they looked at how much interest rate spreads in the US predict non-performing loan history. And guess what? They predict them remarkably well. By the way, I worked on prudential regulation in Argentina in the 1990s, and guess what the capital requirements for loans in Argentina did during the 1990s. They set capital requirements on the basis of all-in interest rate spreads. And the paper that I have with Andy Powell on this shows that it was extremely successful in measuring risk. In other words, maybe you don't need more staff. Maybe what you need to do is measure something that is right in front of your face, which is the bank's own real assessment of risk, which is what they charge for risk. How simple. And in fact, in 2011, I proposed that this was the way we should be doing capital requirements in a paper I called Incentive Robust, a program for incentive robust prudential regulation. In other words, why is this a good simple method? And I want to emphasize there are good simple methods and bad simple methods. A bad simple method is just a leverage ratio. Now, I'm not against keeping a leverage ratio as a belt and suspenders, but if you just have a leverage ratio, of course you incentivize the banking system to do riskier loans and have the less risky loans occurring outside the banking sector. And so you want to have something that's simple but incentive robust. Using the bank's own interest rates is incentive robust because the bank's not going to cut the interest rate, so you wouldn't rob yourself of $1 to save a nickel in terms of your capital charge. So this is a very simple idea. Why regulators don't like it, I have no idea. The one regulator that used it found it was very efficacious. So there's something about agency problems in regulation. I don't think it's just political economy. They want to build a larger apparatus, like all bureaucrats, and so they don't like the simple things. Now, let's go on to the next part of the paper. We'll circle back to the identification issues. There's a huge loan supply effect that comes from the saving of capital here. The authors, this is a big mistake in your paper. You're not drawing attention to what you've really found here. What you found is that changes in required capital have huge effects on bank loan supply. So as I understand this, roughly speaking, these IRB banks are saving about 1 percentage point of capital. And their loan supply is growing by about 9 percentage points. That elasticity, the elasticity of that 1 percentage point savings, so 1 percentage point divided by, I'm going to say about 7 percentage points. So if you do the elasticity, guess what? It's identical to the elasticity reported in my papers on the UK and on a paper on France and on a paper on Spain. So what's really interesting is the evidence for Germany about what's the effect of a change in the minimum capital requirement ratio says that the elasticity of percentage loan change for a percentage change in the capital requirement percentage is about 0.7. And I think your estimates are lining up with that. In fact, your estimates may be, if I'm understanding them, a little bit higher than that. That's quite interesting. So I'm referring to this Spanish work. That was done with provisioning. But provisioning is about $1 of provisioning is worth about 50% of a capital dollar. So they're finding about half of the size of 0.7. The stuff for France and my stuff for the UK with IR and Viladec is finding about 0.7. So this is quite interesting that it's lining up. Okay, so I thought that was interesting, but now we can go a little deeper than you do, because what we find is, you point out that the smaller banks are losing market share, but banks tend to be very specific sectorally in where they lend. So the banks that aren't included in this are going to be differentially affected by how much they share the same sectors of specialization with the IRB banks. So what we found was that the competition in lending that we found in the UK when there was either an increase or a decrease in capital ratio requirements was affecting mainly banks that were specializing in the same loan sectors as the banks that were affected by the bank-specific increases in the capital requirement. So you should be able to find, as a sort of identification check, that the SA banks that are being disadvantaged the most in their relative loan supply are the ones that overlap the most with the IRB banks on a sectoral basis. That would be a nice, strong confirmation of the mechanism. By the way, in our paper in the UK, we found this was hugely important. It's banks tend to specialize in sectors, and this really is very helpful. Now, another thing that you could do is you could check to see, given that your effect seems to be a little bit larger than that 7% effect, what could be making it larger? And there's one obvious reason it could be larger. If you look at what banks are doing with respect to capital ratio requirements, they're maintaining a buffer in addition to the required capital ratio requirement as a kind of protection or insurance against the possibility that they might have some losses and they might have to raise capital. Now, once you're more in control of your own measure of risk-weighted assets, your buffer should go down, because you can react to an increase in your non-performing loans by deciding to take a little bit more chances with your modeling of risk-weighted assets. Well, what that implies is that you should find that when banks are transitioning to IRB, their buffer of their actual average capital ratio relative to their required capital ratio is getting smaller, because they're able to control better the risks. And that is going to also imply that the elasticities that you're finding should be slightly greater than the elasticities in the British and the French and the Spanish studies. And I think you're finding that. But you can also directly confirm a couple of things about at the bank level. Is it true that the extent of the risk-weighted asset shortfall that you're measuring goes up when banks start to have worse NPLs? That is, banks might have an incentive to not just be constant in their gaming of this system, but to be more aggressive in their understatement of risk-weighted assets when they're experiencing some loan losses. That would be interesting to see, and to see whether the buffers fall. Okay, now, we had a discussion already about the adaptation of the regulators over time, or their lack thereof. But I want to, sort of emphasize that the fact that this is so prima facie evident in the form of the interest rates tells you that they're unwilling to do the simple thing, which I think is a real indictment of the supervisory and regulatory process. It's not, as I said before, it's not really a matter of human resources. Now I want to talk briefly about the identification issue. Again, I've already said I don't believe, given the interest rate evidence, that you need to worry too hard about this time-varying firm effects. But I do want to say why I don't like the PD approach. It's clever, but I don't like it. Here's why. Suppose that you didn't have the interest rate evidence, and you're thinking, well, is there an innocent explanation for that finding that you have, that the distortions or the mismeasurement is greater for the low PD part of the sample? Yes. It comes from two possibilities. Suppose that banks are estimating PDs with a linear model, okay, which I'm guessing they're probably some kind of linear model, or some kind of model where the errors in their estimation are going to be bigger in the tails. And let's also suppose that there's a normal kind of innocent selectivity bias. What does that mean? Well, I'm a banker. I do a good job, as best I can with a linear model, estimating the PDs. And when the PDs are very small, I put that into my IRB portfolio, because some of these same, as I understand it, it's the same bank may have an SA portfolio and an IRB portfolio. Is that right? So, or maybe I lose out in competition to another bank that's doing. So the point is a combination of a normal kind of, that the errors are bigger in the tails, combined with a selectivity bias, which is what you're worrying about in the first place, could actually innocently create the fact that the errors are bigger when you do the low PD comparisons. So if I use my linear model, I'll tend to be more making errors in the low PDs, and then because I'm making errors that are underestimating it, I will retain that more in the IRB rather than in the SA. So I think another thing you could do, if you want to do this more convincingly, although I don't think you need to, is that you would look at whether the distributions are different. That is it true that the IRBs have a sort of missing tails that the SAs have missing tails in the low PD parts relative to the IRBs. So look at the whole distribution of the SAs and the IRBs, and I'm going to guess that there might be a selectivity bias that would take the form of low PD is more populated in the IRB portfolio than it is in the SA portfolio. That would be an indication of selectivity bias. But again, none of this amounts to a hill of beans because you've got the interest rate evidence, and I don't think that you need to kill yourselves over the identification issues. So my overall comment is this is a great paper. There's a lot more you can do to talk about this as a contribution to the literature on how capital ratio requirements affect loan supply. Sorry, Admati and Helwig. Reality, once again, slaps you in the face, to use Gary Gorton's phrase. And thank you very much.
All right, so the theory underlying this is a little bit more complex than the parent who's just monitoring chocolate bars. Because the parent actually knows the calories of the chocolate bars, what a kid should be eating. I mean, they're very well informed. The child's not well informed, and that clearly would be kind of a nutty thing to do. But this paper actually has there's two possible underlying theories. And then what I'm going to do when later on, I'm going to kind of describe a third that I think might be also going on that we have to worry about. So the first is, some underlying model of Bayesian persuasion, where you've got a sender who's fully rational and a receiver who's also fully rational and is a rational Bayesian. And so kind of the landmark paper was by Matt and Amir. And what's kind of interesting is that you'd wonder how a sender could persuade a Bayesian receiver. It turns out that by deciding how to choose the discovery materials, the probabilities of different outcomes, they can manipulate the Bayesian receiver into doing other things. So their leading example is, you have a prosecutor who is trying to do discovery, and the prosecutor wants to put the person in jail. That's what they get paid to do. And the judge knows that there's a 30% chance that the person's guilty, but yet by choosing discovery strategically, the judge will actually end up committing putting the person in jail 60% of the time. And so there's an actual Bayesian, and this is a beautiful paper. If you want really beautiful theory, Amir and Matt's paper is amazing. So that's one thing that could be happening here in the paper. The other is that this could simply be a story of complexity and obfuscation. And so, you've got the law that allows you the regulation allows you to do this. And so in some sense, you have this rational sender and this naive receiver who's going to, the naive receiver is going to get shrouded, and therefore the bank is going to get a chance to take advantage of the situation. So either one of those situations is kind of what you could see they have in mind. Later on, I'll come back to this and add to this. So, what do they do? Well, I think it's been well described today. I mean, you had this transition from the standard approach, which was a much less precise estimate of risk. It was very coarse. Hopefully, by letting the banks provide some private information in some way, you're enhancing this. And so this would lead to a better assessment of capital markets and less financial fragility. And of course, the IRB approach, there were two types. One was more simple than the other. One's a foundation IRB and one's a more advanced IRB, where with the foundation IRB, you're getting more discretion than the standard approach. But with the advanced, you're getting even more discretion, okay? And so the advanced is obviously more complex. Now, as has been pointed out, this IRB is not easy, okay? This is not like you just sort of say, okay, well, we can just kind of get a software program and just kind of switch gears and we're all done. There's a large fixed cost. Only 45 of the banks adopted it, of all the banks. it takes a long time to adopt, okay, and you've got to pose models. It requires empirical expertise, which we all know is a scarce resource, okay, in the world. And so, these models need to be assessed and updated, and this makes it very hard for an outsider to monitor what's going on inside, except by looking at the ex post performance. So the adoption of the IRB is not something that's just kind of simple, and they say, okay, now you get the chance to shroud, and it is actually very complicated. So what do they find? Well, the two main tables I found in the paper to be the most telling was Table 2 and Table 10. And so Table 2 compares outcomes between the standard approach and the IRB. Okay, and so these are the things that have been emphasized. With the standard approach, they predict a higher probability of default. Okay, so in some sense, the IRB is lower. However, the standard approach had lower actual default, okay, and therefore a lower estimation error. And when you start to look at the interest rates that are charged, the SA charged a lower interest rate than the IRB. And so this is sort of the smoking gun that we were kind of talking about, that the banks knew that the higher risk loans were riskier, and so they charge a higher yield rate. Now, if you look at the foundation versus the advanced, you'd expect that same monotonic relationship. As you have more complexity, you have more discretion, and therefore this should kind of go through. But actually, it doesn't really, okay? In some of the facts, it does, but if you look at it, the foundation actually predicted a lower PD prediction than the advanced, okay? And so there, you're really not seeing that shrouding, okay? And the actual default rates were equivocal, and you had a lower loss rate in the foundation. So the foundation is predicting lower default rates, and you end up having lower actual losses than the advanced one, which is predicting higher and had a higher loss rate. And so there, things seem to line up for what you would think might happen. And so, it's not clear that this is a monotonic relationship between discretion and sort of manipulation. Because from SA to the IRB, you see it, but from the IRB foundation to the advanced, you don't really see it, okay? So what are the implications of the paper? Well, clearly I think that manipulation is, I think it is in the data. I think that what they've identified is probably going on. It may not be going on with the advanced case, okay? I think the empirical analysis is very convincing, and the authors are really good. I think the one thing I'd like to see from the empirical analysis is that if you could add some more independent variables with regard to the loan type might help us to give more pointed recommendations to the regulators. Because in some cases, perhaps there's not that much error or not that much room to wiggle, so you can do this by IRB. But in other cases where it's harder to assess or this kind of thing, perhaps you might want to have the standard approach used. So perhaps looking at different types of loans where they're more or less easy to assess, you might want to look into this more. Now, one of the things I thought about, especially in light of this foundation and advanced case, was what are the other ideas? Like, what kinds of other things could be going on here? Okay, and so what you have is kind of a new technology, a new innovation, and the ramifications from the innovation in this German setting. So like we can think of, let's suppose an auto manufacturer improves their capability and the complexity of their computers, you know, the authors would basically propose that, you know, this would be done for manipulating reasons, and so, you know, and it was, and that's perfectly fine, okay? And I agree with the authors that the other thing, though, is that when you increase the computer capability, you end up being a lot less certain about all the capabilities of the car. And so we're not able to fix our own cars, and as they become more and more computerized, you don't know exactly how to you know, how to use the functions of the car. I mean, there's knobs everywhere, and there's things you just don't even use anymore. So you're uncertain about the model, and so when you start increasing the complexity, this can lead to model uncertainty. Okay? And so there's two possibilities of other explanations that are going on here. Now, the first is that there's just really, you know, limited expertise. Okay? And so, you know, people are just creating noise, they're making these assessments, they don't really know what's going on. So the underlying model would be one of a boundedly rational sender and a boundedly rational receiver, and really the boundedly rational sender is just giving true disclosure, they're just making all kinds of mistakes. Okay, and so this would be consistent with the long ramp-up period, the empirical expertise that's required. However, it's unclear why the mistakes would induce a one-way bias into, you know, lower than higher. But it's possible that it could. Looking at the standard deviation of the probability of default estimates, they're about the same as the IRB, which makes this explanation a lot less likely. Again, I don't know how this would explain the lower interest rates. Now, the other one, however, can explain the increase in interest rates. And so, you know, it could be that when you're dealing with more, you know, a more complicated situation, you have more model uncertainty. And so this was introduced by Lars and Tom, and basically, in previous work that I've done, you know, just recently, theoretically, I've shown that model uncertainty is associated with a risk premium. Additionally, empirically, in the mortgage-backed security market, model uncertainty or model disagreement is associated with a risk premium. Okay? And so, in this particular paper, what we were able to collect were prepayment speed forecasts from mortgage dealers, and we could actually track their deviations from each other. Now, of course, a prepayment model is going to be based on observable things like, you know, unemployment, inflation, all kinds of things like this. These are all publicly observable to these dealers, but they're all using different models. Okay? And so you could get a situation where you've got this complex technology, it requires empirical expertise, you end up with more model uncertainty, and therefore a risk premium that's associated with the model uncertainty, and you end up with higher interest rates. Now again, you would wonder, why is there a one-way bias in the PD estimates? It's only over a few years that you're seeing this, and so, you know, it's possible that this is downward bias, but this is really because the models are this is the sample that you've collected, okay? I'm not saying that there's no manipulation, but the fact of the matter is perhaps you could measure some PD dispersions over time and characterize it by loan classes that are, perhaps you think are harder to assess, and so perhaps you could, figure this into the analysis. Okay, net, do I believe there's manipulation going on? Yeah, I think there's manipulation going on. The authors were very truthful and honest in the reporting of the data, and that's why, I'm highlighting some of the advanced versus foundation effects. And so that allows us to not only think about manipulation and because of discretion, but also because of the model uncertainty that it imposes, and this is an important idea. Okay. Now, I really think that as we go to Basel IV and Basel V and 6.0, I think there has to be some simplification and some more precision with the implementation. And just increasing the size of the requirements is not what's going to do it. And I think that the authors, perhaps in a future paper, if they could characterize within certain loan classes which ones are better for simplification versus complexity, I think that's where they're going to be able to tell the regulators how to achieve this correct balance between complexity and simplicity. Okay, so thank you very much.